very much, guys, for listening in. I'm going to run you through a presentation pack. I'm the fund manager on a European-focused investment trust called Henderson EuroTrust. So I'll tell you a little bit about what I do, how I do it, and whether I've been successful or not at doing so, over the last few years, and some of the things that we're looking at to invest in at the moment. So let's kick off. So first of all, what is my approach? How do I do things? I've got a very big universe, the whole of European investment universe, any company listed in Europe essentially, not the UK, so continental Europe, and I can invest in just about anything I want within that market. So what drives me and what are the kind of things I look for? Predominantly, there's two kinds of companies that I'll look for within Europe. And I have very simple names for these companies: compounders and improvers. So I'll explain briefly what these are. So compounders I would describe as really high quality businesses in Europe. These are businesses that have a really high return on capital, i.e. when they invest money, they get a high return on that invested capital. And these are businesses that, crucially, I think the return on invested capital will stay high for longer than the market thinks. And therein lies the opportunity in investing in these businesses. And then on the flip side of things, the second thing I look for are what I call improvers. So these are businesses where return on capital at the point of investment might be quite low. They might be almost the opposite to those compounders, but there's something about that business or something about that industry that suggests to me that they're going to become better businesses. The industry is going to improve and return on capital will improve with it. And again, crucially, it's not sufficient to find, clearly it's not sufficient to just find a low return company. You need to find one where returns are improving and where the market does not expect it to improve, or not to the extent that you're expecting. So those are the two things I do. And then I break down the portfolio into these two types of opportunity, and you can see the breakdown here. And I won't go through, go through number by number here, but essentially these are the kind of characteristics you should expect. The compounders would have high return on equity, generally decent earnings growth, and reasonably high valuations. The improvers would kind of be the opposite: lower return on equity, generally lower growth, not always the case, obviously. And a much lower valuation, and then EuroTrust is a blend of those two things. So at the moment, the split between the two is about 56–57% of the trust is in the compounders, and about 40% improvers, and that varies a bit over time. Now, how have I done? What's driven? So I took over this investment trust. I took over the management back at the end of 2018. So you can see the numbers since then. Performance has been really strong, but year to date really struggled. So it's been a really good kind of 3-year period where I've significantly outperformed European markets, but had a really tough time in the last year or so. And I'll come on and talk about some of the reasons behind that in a second. Click on to the next slide. So when you think about EuroTrust, this is an investment vehicle where the performance over time is entirely going to be driven by the stocks that I pick. So if I pick the right stocks, we're going to do well. If I pick the bad stocks, it's not going to do so well. And that is what drives performance. It's not so much sector allocation or country allocation or even style allocation. It is all about the companies. So since I've taken over, you can see what has contributed strongly and what's done, what has contributed negatively. Our real winners here have been things like DSM, which is a Dutch chemicals company that's transitioning to being a food ingredients business, a real sustainability focused company, a great business. Novo Nordisk, which is a Danish pharmaceutical company focused on originally insulin and that now some more novel categories to help with diabetes. Partners Group is a private equity company. So those are kind of things that have done well for us. And on the negative side of things, we've lost some money investing in some gaming companies and some payments companies actually, and those have really driven the negative returns that we've seen over the last 9 months or so. But altogether, a successful, very nearly 3-year period. Another way to look at performance, and this comes back to what I was saying earlier in terms of performance being driven by the stocks, individual companies, and not the sectors, is if you look at this chart, which breaks down the market into the sectors that I could invest in, and if you look at the 3 columns on the right-hand side, sector allocation, stock selection, and the total effect, Sector allocation is the contribution from my sector picks. So whether I'm overweight or underweight sectors and what's that done to returns. And if you go right down to the bottom on the total row, you can see that over 3 years, it's contributed almost nothing, actually a negative contribution. So all of the performance has come from the next column, which is stock selection. And that is, have I picked the right stocks in each sector? And you can see there, going down the list, materials, I've picked the right stocks, essentially I haven't owned things like miners, instead I've owned DSM, which is, most people wouldn't regard as a materials company, but has its origins as a chemicals company. So stock picking is what drives returns. It's really interesting for me now, looking back over the last 2 years, to kind of think back and remember the strong performance, or exceptionally strong performance in 2020, and now the quite painful underperformance in 2021. But to look at those 2 years together. So this is a kind of a split of those 2 years using the same format as the previous slide. So again, you can see those same columns there, and you can see that in both years, the contribution from sectors is nothing. The contribution from stock selection is dominant, both in terms of good years last year, bad years this year. Thankfully, add the 2 years together, you still have a good result. But it's an important thing to bear in mind when investing in EuroTrust and other investment trusts. Performance can be volatile. We are trying to outperform the market, and when you try and outperform the market by having a reasonably concentrated list of companies, you'd hope to do well over time, but you can go through 6-12 month periods where performance is not so good, and we've certainly seen that year to date. So thinking about 2020 and 2021 is super interesting to kind of break those 2 years up, and I've tried to illustrate this here. So what's happened? So if you look at these charts, and if you kind of draw a line down the middle of each one, then on the left-hand side of that line is 2020, and on the right-hand side is 2021. Stillfront is a gaming company, so this was a big perceived COVID beneficiary. People were sitting at home, people weren't commuting, people suddenly found themselves a bit more time to play some computer games. And so we saw a big boost to the business in 2020. In 2021, when suddenly people are kind of allowed out again, that business has deteriorated, the momentum of that company has deteriorated, and you can see that clearly in the share price. So it's 2 years that have been very volatile and very different performance in both. And then you look at BAWAG, just to use another example. BAWAG is an Austrian bank. So as you can imagine, a bank wouldn't have done so well during COVID, and you can see because these are economically sensitive investments. So you can see the performance of that business at the start of the COVID crisis, big fall from 45 to 20 on the share price. But since, as people have tried to buy into the recovery, you see a very strong share price recovery. So these two stocks really illustrate the last 2 years, illustrate the volatility in performance in the market and in what's driven that performance, but also the volatility in performance of EuroTrust. That is why we did so well in 2020 and why we struggled in 2021. It's the very things that helped us in 2020 that have hurt us in 2021. I won't dwell too long on this. This just shows the exposure via those 2 categories I talked about earlier on, the compounders and the improvers. You see fairly balanced over time. I made a bit of a shift in October 2020. That, if you remember back, that was just before we had the Pfizer vaccine data efficacy announcement, which was very positive for the market, but sent all of these COVID beneficiaries down because people wanted to play the recovery, and sent the banks and the airlines up. In and around that point, I made a shift in the portfolio towards those companies. They tended to be companies that I would describe as improvers. And so you can see the weighting of improvers increasing at that time and has faded back to kind of more normal levels since. So there's been 2 periods where I've made significant changes to positioning over the last 12 months. The first was that period I've just described to you there. And you can see on the left-hand side, I've split the portfolio into COVID beneficiaries, more neutrally impacted positions, and reopening beneficiaries. Quite a crude breakdown, but it just illustrates the point, and it illustrates the amount of change I put through the portfolio at that time. You can see, in fact, the reopening beneficiaries go from being 13 and a bit % of the trust to 27, 28%, and that happened in the space of a month and a half. So quite a I'm willing to take big changes when I see the right opportunity to do so. You can see on the right-hand side, sorry, the companies that I bought at that time, and pleasingly, those were the right things to have done. things like CNH and Dialogue have been really stellar performing companies since. So, we're active fund managers. We'll make decisions. We'll change the portfolio around where we see fit. We'd love to invest in some of these companies forever, and with certain companies, that may be the case. We'll invest for multiple years. Sometimes we'll react to market opportunities and try and take those. One of the other observations I've made more recently, and this is going back kind of midway through this year, and this for me is quite an interesting one. If you think about the moment when we all went home, we all went home for the first time, whenever it was, March 2020, and we felt that we were going home for, I remember at the time coming home telling my wife, I'm going to be here for 8 weeks, and then we'll be back in the office. 12 months later, it was still the case that I was at home. So the moment we went home was actually the moment that the performance of these kind of companies that were deemed to be beneficiaries of what was going on peaked. And the relative performance of things like Roche, a pharmaceutical defensive company, Danone, a food producer, Beiersdorf, they own the brand Nivea, those kind of companies, they were perceived as defensive, so the share prices did very well initially. They've given back all of those COVID boosts, all of the gain from that period. And so more recently, I've kind of moved quite heavily back into this area. So I've been buying things like Danone, things like Beiersdorf. I've added to position in Roche and other pharmaceutical companies, because it's almost like the world the equity market anyway, has kind of moved on from COVID and assumed that it never happened. And these things have all derated heavily. So that creates opportunity. Again, volatility in the share prices has created what are hopefully going to be good opportunities for investment if those play out as I expect. There's another example of the kind of businesses that I could invest in. I can invest in a number of companies in Europe, but these are some of the things I actually have done, over the last 12 months. CNHI, I mentioned earlier, this is a tractor company. When I bought the position, which was in kind of October last year, the shares were super depressed. They were super depressed because everyone thought that at that point that COVID was going to have a very significant economic impact. That would have a knock-on impact on the agricultural markets, and tractors would not be bought. It turned out, and at the time, a lot of analysis we did was that it showed us that actually the agricultural market was proving very strong. Soft commodity prices were high. Farmers were actually quite flush with cash, especially in the US. And we felt that there was an opportunity to initiate a position at a very depressed valuation. That's worked very well. Stellantis, similar auto company, we initiated right at the start of this year. And then some kind of higher quality businesses, Adidas, we all know, which we bought halfway through this year. That one actually hasn't worked yet. And who knows, maybe that's been a mistake. Certainly has been so far, but we will see how that one plays out. And then Danone and Beiersdorf, those two fairly dull consumer staples businesses, but businesses we think has a lot of potential for improvement, and the valuations have come down a long way. So a couple of things I'll finish on. I was told to keep the presentation nice and brief, so I'll try and stick to the script. But there's two things worth mentioning when you think about EuroTrust and you think about the future. Firstly, sustainability. I mean, it would almost be impossible for me to produce a presentation back and not have a slide on sustainability, given obvious interest areas in obvious interest levels in the area. And that incidentally is not something that we're coming up with as we should think more about sustainability. It's coming from our shareholders. Our shareholders, people who invest in EuroTrust, want us to more and more integrate sustainability considerations into our investing. So that's what we're doing. For a long time, we've been a trust, and we've got a 20 plus year history. We've always wanted to buy good quality businesses generally, and there's always a correlation between quality and kind of sustainability. So we've always been quite exposed to good sustainable businesses. But going forward, that focus will increase, and the disclosure around it will increase. So what are we going to do in the future? Well, we are considering the transition to Article 8. I say considering, the shareholders actually voted positively on that today at our AGM. So we will become an Article 8 fund, which is light green under the SFDR classifications. And this means a few things. So firstly, we remain focused on trying to deliver the best total return we can to you guys, to shareholders, to people who buy shares in EuroTrust. We want the shares to go up as much as we can over time. But we will also now look at a few more relevant sustainability metrics and try and invest behind those. So what are the things we're going to do? Firstly, we've decided that we will no longer invest in any company that derives more than 5% of the revenues from certain activities that we deem as unfit for investment. Tobacco, for example, adult entertainment, palm oil, a few different things there. We'll also invest no more than 5% of the portfolio in companies that are rated badly by ESG risk rating agencies. And the board, there's a board that provides oversight for me, and that board will provide additional oversight of these kind of positions when I do have one or two in the portfolio. We're also going to take quite big steps in carbon intensity. So we will exclude the bottom 5% of companies in the index when ranked by carbon intensity. Now, that doesn't sound like a massive commitment, 5 out of every 100 companies, great. However, those 5% of companies in the index are at the bottom, the bottom 5%, they account for something in the region of 40 to 50% of the carbon emissions of all listed companies in Europe. So by cutting out that 5%, you really make a big difference in the exposure of the overall portfolio. And we're also going to make commitments around investing behind companies aligned with the UN Sustainability Development Goal of good health and well-being. That's something we feel strongly about. And also we'll invest in only companies that are compliant with the UNGC. Final thing to mention is the dividend policy, and this is, at first glance, is maybe a slightly dull subject, but I think it's important. For years, we've had a progressive dividend policy. So we try to grow the dividend year in, year out. My feeling and the feeling of the board was that was in some ways verging on constraining my ability to invest as I see fit to try and drive the most attractive total return for shareholders over time. You find yourself in a position where you want to sell something or you want to buy something, but you have to consider what it yields first because you've got this progressive policy. So instead, what we're doing is we've decided simply that I will invest in the companies that I see fit, and when I invest in those companies, whatever dividend yield they have, whatever income they generate, will be returned to shareholders as the dividend from the overall trust. So that is how we're going to go going forward. That was approved by our shareholders and by the board. And those are those last two slides, so the major changes that have happened to EuroTrust to help you think about the future. So in summary, we remain absolutely focused on delivering the best total return we can to our shareholders over time. I've done a good job so far. I'm very well aware it's 3 years in, and I want to be talking about a good job after 10 and 20 years. So we've got a long way to go. But I'm very excited about the opportunities in front of me in Europe, and I'll continue to try and find the best of those opportunities for you as shareholders. So with that, I'm happy to take any questions that there might be. Thank you for listening.
Amy, that's super. Thank you very much indeed. Okay. Quite a lot of questions here, so we will crack on. First up, do you go and meet management face-to-face, and have you been able to do so during the pandemic?
Great question, and actually the answer is maybe a little bit different to what you might expect. Well, do we meet companies all the time? One of the great privileges actually of my role, thinking back to when I first started, in my 20s, being able to meet the CEO of some massive company in Europe and be able to question him on his business. It's a fantastic privilege. It's something that's hugely important as part of the investment process. We must do this. We must meet companies. We must find out about the businesses from the horse's mouth, so to speak. So yes, we do it all the time. And in terms of how that's evolved over during the lockdown period, the situation's actually improved in terms of our access to companies. And the reason being that if we think back to just prior to COVID, as an example, I travelled to Milan to go and meet Telecom Italia's CEO. And I travelled to Milan, shook his hand, had an hour-and-a-half meeting, had lunch, jumped on the plane, came home. That's a day. It's a day to meet one company. During lockdown period, I was on Zoom calls all the time. Meet a company I know well, talk to them for 15 minutes. Meet a company I don't know well, talk to them for 2 hours. On a call, on another call, no travel in between. So it's been great. And I think the hybrid world we're moving to, where I'm in the office half the time or traveling half the time, but actually at home half the time, is going to be great and really conducive to continuing to meet as many companies as I possibly can.
Next up, a question about leverage, gearing. Does the trust use gearing, and to what extent, and has that changed?
Yes, so it hasn't changed. We've always been able to use gearing, and this is a fantastic benefit of the investment trust structure. If you think about an open-ended fund, an OIC in UK terms, generally those are unable to be geared. The investment trusts, we're a company, we can take on gearing, we can take on leverage and invest that in equities. And if you believe in the history of equity markets return and the fact that generally over time, although they're volatile, equity markets go up because companies create value, and hopefully the companies I invest in create even more value than the companies in the index as a whole, then leverage is a good thing within reason. So we can invest up to about 25 million additional to the capital of the trust in gearing, which would take us up to kind of around 7 or 8% geared. At the moment, we have no gearing, but the reason for that is simply that I haven't found the opportunities I want to use the gearing at this precise moment. When I find those opportunities, gearing will creep up. Over the time I've run the trust, we've generally been geared by a few percent. So yeah, it's a very useful tool and one that I do plan to generally use over time.
Okay, the question here, could you explain or contrast the trust with the Henderson European Focus Trust, another one from the same stable?
Yeah, sure. Got to be careful here because actually the other fund you mentioned, Heft, is run by my boss. And he's probably on this call, it's probably his question. So what are the differences? So if I think about stylistic differences, this is the major thing. John Bennett, who runs Heft, he tends to be someone who, in his own, I've been to many of his presentations, I sit very close to him. In his own words, he's someone who is kind of style agnostic. So there are times when he will be very value focused, will own things like banks and oil and whatever else he sees fit. And there are times when he thinks he will be very growthy focused. So, own high quality, high valuation companies. So he'll go all across the spectrum of style. Whereas with me, if I think about the European market and I think value at one end, growth at the other, and in the middle, kind of blend, a blend of styles, I will always be between blend and growth. So my stylistic bias is always towards, I want to own good businesses. If I can find loads of good businesses, loads of high quality growing companies, I won't own any of the kind of more value end of the market. So that's the major difference.
Super. Is there a minimum market cap or the smallest company size that you might invest in?
So there's officially anything listed in Europe is fair game. And actually another advantage, of course, of a closed-end structure is that you don't get redemptions and you don't get inflows, unless you're trading at a premium, you issue shares. So that means there's a fixed pool of capital. And that actually gives me some quite decent flexibility, and I can invest in slightly less liquid situations. However, I'm very aware of the risks of doing so, and so I tend to be invested in relatively liquid companies. So anything under $1 billion market cap is unlikely to be my kind of hunting ground. Anything over $1 billion tends to be fair game. And actually, we've got another investment trust at Janus Henderson that focuses on the smaller cap area of the market. And so, that's their kind of area. So $1 billion plus is my usual range.
Super. And a couple of questions on the ESG comments, and one that I think is quite good. How do you think about divesting ESG unfriendly assets as opposed to engaging and working with them to improve?
It's a brilliant question, and one that if I answered in full will take me well over my allotted time and I'll get in trouble. There's two approaches here. You can argue that if you just divest a company that is unfriendly on some metric of sustainability that you look at, someone else buys it and that person might not care or might not be driven by the same thing. So it goes into different hands and might carry on polluting or whatever it is. And so that argument goes along the lines that actually stay invested and engage with that company and try and force change. We do a bit of both in reality. There are certain red lines that we will not cross. I'm not going to invest in a pornography company for, not that I know of any in Europe, but that's not my thing. I will not invest in a tobacco company. I think fundamentally that's not something that I want to do. So there are red lines I won't cross, but there are a number of companies in my portfolio that I have tried to encourage over time to disclose more, to move in a more environmentally friendly way, for example. And so it's a bit of both. It's the red lines I won't cross, and it's engagement with those companies I will invest in.
Super. We've got lots more questions, but I think probably only time for one more. So this one's quite nice. Do you have a view on the energy transition and the investment opportunities this may create in Europe?
I do, and for a while I've tried to expose myself on the right side of that trade. So what I don't own, this actually comes back to the previous question in a way, what I don't own is big oil, for example, or anything in the oil services industry. For me, those companies, they're changing, and engagement may change them faster or force them into changing faster, but not quick enough for my liking. And I think ultimately the cost of capital in those businesses has risen quite a lot. I mean, the oil price has gone up, so these companies have gone up over the last 12 months. I don't own any, so that's been a negative for me. But if you look at how much the oil price has gone up, these companies have derated a lot, and they've derated a lot because people don't want to own these kind of assets. On the other side of things, you know, I think there's some really interesting renewable energy companies in Europe. The difficulty is finding them at the right valuation. You know, companies that are really heavily exposed to the renewable energy, the transition, you know, Ørsted, for example, are quite expensive, or some solar companies or some wind turbine companies. I don't find that attractive at this stage. We've got a position in NL, which is a utility company that is transitioning from a slightly dirtier path, so to speak, from a sustainability point of view, towards renewables and grids. So, you know, electrification of the world. And that's something we're playing behind. But there's many ways to do this. But yes, I'm a believer that you should be looking to invest kind of behind, or certainly I am looking to invest behind that theme over time.
Super. Jamie, that's terrific. Thank you very much indeed for joining us tonight.
Thank you, and great questions. Thanks, guys. Have a good evening.